For more information, please visit SGMAK Associates website.
Hi, here's a short presentation on the concept of net present value. Idea is to let you know how do you find out whether a project is viable. What I've done, I've set an example around buying a machine. If you are buying a machine if you're working in industry, managing a process, and you need a new machine to purchase, this simple example tells you, based on cash flow analysis only, whether you should purchase the machine or not. So if I think purchasing a machine as a project, so I give a generic definition or definition of this presentation as, how do you know a project is viable based on cost-benefit analysis? It's a simplistic view based on primarily cash flow analysis only. It doesn't bring in other intangibles. If you say one machine is better than the other, then it has to be translated in terms of cost, maybe more benefit, less expensive to maintain. So that's what you're talking about here. So let's look at a problem statement. Our initial cost, purchase cost of a machine is $750,000, $750,000. Annual expected benefits that you get from the machine, you can think about net benefit. I didn't bring in any cost here. A typical structure will have an annual cost, annual benefit. We expect benefit to be more than the cost, so then that's what we talk about net benefit. So in this case, expected net benefit, take it as $150,000. Useful life. Every machine from an OEM, and based on your prior experience, you can put a useful life on the machine, beyond which you got to take a decision whether you keep the machine. Your maintenance cost typically goes up, or do you retire a machine and get a new machine at a higher price. So useful life we are taking as a 10 years, a representative life. Salvage value. Salvage value is at the end of a useful life, depending on the health of the machine, you can still dispose that machine. You can buy a new seller who will be willing to pay much less amount, but you still may have some resale value. Now that's what called a salvage value. Now it could be positive, it could well be negative also, because if you search that, what the machine, removing the machine is going to cost you money, because it may have some toxic material that it handles, and the site has to be cleaned as you remove the machine for the next machine to be installed. Then it may have a negative salvage value. That means it's going to cost you to prepare the site again for the next machine. So here we have taken a salvage value to be our $25,000. You can see it is much less compared to the initial cost, and this is 10 years out, end of useful life. So with given that cost data, and so you have taken initial cost, net annual benefit, and a salvage value and useful life, and then you are using a borrowing rate from the bank, from the lending institute at 8% APR. Your objective is, the question that you have is, should you buy this machine or not, based on this data alone. And your rationale will be, you'll compute the net present value, which is the present value of all the benefits minus present value of all the cost. If the net present value is positive, then buying this machine and keeping it for 10 years, adding some value to your company, to the organization. If it's a zero, then you didn't gain anything, you didn't lose anything, you're neutral. And then if it's a negative, of course, it's definitely a no, unless there's other consideration. Your simply benefit didn't recover the cost. So net present value by definition is the difference between present value of all benefits minus present value of all costs. So let's look at what you net present value we compute by we took the annual benefit and find its present value by using the P over A factor at 8% rate for 10 years. We are taking cash flow at the end of each year for 10 years. Salvage value a single cash flow at the end of 10 years. We are bringing into the present by using the factor P over F. And $750,000 that you pay is right now. You're looking all this cost benefit in the future for 10 years. So in computing present value where the future cash flows are to be discounted and brought to the present, the initial cost is sitting right at the present and it doesn't need any discounting factor. So we subtract $750,000 and the net present value comes out to be this factor P over A at 8% for 10 years. It comes from a lookup table. Same thing, the factor P over F, 8 and 10 is being used to bring up a future value 10 years from now to the present at 8% discount rate per year. So those two factors are table lookup, and using those values you get a net present value of $268,080, which is positive. So your simple decision will be purchase the machine. Yes, machine adds value. With net benefit, it exceeds the net cost, so it's adding value to the organization. It's a buy. Now we just wanted to see if the borrowing rate was higher at 12% rate. We simply, all that you're doing is changing the discount rate. Factors remain the same in the previous equation. So we're using factor P over A 12 and 10 and P over F 12 and 10. At higher discount rate, the borrowing rate is higher. Again, we compute the net present value. It's a smaller amount, but it's still pretty much positive, $105,550. So even at 12% rate, it's a go. We'll keep the machine. So the major takeaway from this short presentation is viability of a project based on cash flow analysis only can be decided by finding out the net present value of the project, which by definition is the present value of benefit minus the present value of cost. Everything has to be brought to the present using proper discounting factor. If the net present value is positive, project is a go. You can go with it because it's adding value to the company. If it's equals 0, then there's no gain, but there's no loss also. And if it's less than 0, then you are losing by buying this machine or executing this project. So answer will be no. So in this case, both examples showed your answer is at 8% and 12% discount rate. Given the cost data, you'll buy the machine. But the takeaway is concept of net present value, how to compute it, and how to make a decision based on net present value for a project. For a project to be viable, net present value has to be positive, greater than 0. Okay? All right, I'll come back again with more material. Bye now. Hi, we are posting materials online. If you have any doubts or any questions regarding the materials posted, feel free to get in touch with us through email. Provide your name, address, school name, your contact information. We also welcome if you provide comments so that things can be improved upon. We also appreciate if you provide any feedback. Okay, so let us know what do you think about the material posted. Okay, bye now.
For more information, please visit SGMAK Associates website. For For more information, please visit SGMAK Associates website. For more information, please visit SGMAK Associates website.